Well, greetings everyone, and welcome to the August 2023 review of markets, including the Argonaut Absolute Return Fund. Well, what happened to markets during the month and how did the fund do? Well, bond and equity markets both delivered negative returns during the month, but the fund delivered a positive return. The first 3 weeks of the month saw a rise in Treasury yields, a steepening of the yield curve, which saw the 10-year yield in the US rise from 3.94% to 4.34%, which is the highest since 2007. And that was due not only to the negative supply-demand imbalance we talked about last month, whereby there's a 4 trillion hole in the treasury market that private investors have got to fill every year, but also due to largely robust economic data, evidenced by the St. Louis Regional Fed best estimate of Q3 GDP in the US now 5.6%, so a significant re-acceleration despite the interest rate rises. And as we also suggested, as the US Treasury yield anchors the price of risk assets worldwide, and it had risen to the highest level since 2007, that would have a negative reassessment in the values of risk assets worldwide, including stock markets. So what we saw is equity markets worldwide fall about 5% in the first 3 weeks of the month, and then rally in the last week, recover about half of their losses as the economic data in the US moderated, particularly in the labor market, leading to hopes that this disinflationary soft landing narrative could continue. Fed Chairman Powell gave his annual Jackson Hole Symposium speech, where he reiterated his higher for longer interest rate stance, although we would note that he allowed himself a high degree of wiggle room for future policy change by suggesting that Fed officials were navigating by the stars under cloudy skies. In other words, that future policy would be data dependent, but in any case, their data sets weren't that good anyway. So the capacity for getting it wrong would potentially be quite high. So the fund returned just over 4% in August, and the fund made 1% in its long book and 3.3% in its short book. So we made returns on both sides of its book, which is what we like to see. The correlation to the market and risk assets, and therefore most other equity funds, was also zero, which is also what we like to see. And the annualized daily standard deviation of the fund was just 8.2%, which is also much lower volatility than the market, which is also what we'd like to see. We had a range of stocks that did well. The best performing stocks in the long book were insulin for obesity, pharmaceutical outfits, Novo Nordisk and Eli Lilly. We also had strong returns from Norwegian shipping company Hafnia and Hungarian bank OTP. And then on the short side, we had a number of successes. Online clothing, luxury clothing retailer Farfetch halved during the month on a significant profit warning where growth disappointed. And we had 4 or 5 other stocks which were down more than 25%, including wind farm operator, or the biggest pure play wind farm operator in the world, Ørsted, which fell 25% on a big profit warning, where it admitted that its US operations weren't as profitable as the market thought. Now, those of you who had watched my appearance on GB News a few weeks ago would, of course, already be aware of that fact, which nevertheless came as a surprise to the market. One of the things that certainly we're talking about at the moment is the risk of a 1987 style stock market crash. So in 1987, the 10-year yield started off about 7%. We had similar fiscal deficits that we have at the moment. reasonably strong economic growth. And by October, the yield on the 10-year note had risen to 10%. Now, throughout the year, the market hadn't really taken much notice of this. In fact, equity markets have been benign. And then 10% proved the tipping point. The market, as people who were around at that time will know, fell 30% in just 1 month. Now, I think there's a similar dynamic at play now, where, as we've discussed, there's this supply-demand dynamic where the US government has to plug a $4 trillion hole every year, and those key buyers of US treasuries like global central banks, China, Japan, are no longer buying US treasuries. So whilst the market has been fixated on disinflation and a soft landing scenario, rather than the continued rise in interest rates that will impact negatively on equity market valuations, we think that, in fact, this has made a hard landing scenario more rather than less likely. So if we think now that the yield on the 10-year Treasury hit an all-time low of just 0.5% in August 2020, and now is 4.2%, so just 3 years later, and that's the highest since 2007. So this is a massive round trip in Treasury yields. And certainly, if you study the charts, you would think that the era of low interest rates is decisively over, and we're never going back to zero interest rates, which perhaps many people in the market think. And I would say if this yield keeps climbing, and this validates the obviously higher for longer scenario that Chairman Powell is trying to outline, that long duration Treasury yields start to rise, then this is a discount rate that every equity analyst must start putting into their models. That will have an effect on valuations, and gradually and perhaps suddenly we could see a 1987 style stock market crash. So it's interesting that until perhaps the 1930s, politicians and economists really didn't think that governments should meddle in the workings of the economy. And it was only post-World War II, when John Maynard Keynes' ideas on counter-cyclical fiscal spending became popular, that governments started running deficits, particularly during economic recessions, in order to help spend their way out of recession. Now, interestingly, during that time, it was rare for deficits to rise above 5% of GDP. Today, we have the absurd situation where the fiscal deficit in the US is 8% of GDP, and this is happening at a time of full employment, and where the Federal Reserve has hiked by 525 basis points in 18 months to try and slow down a red-hot economy. So, to my mind, government handouts or subsidies, or trying to pick winners in strategic industries, or simply pork barrel politics in order to gain popularity before the next presidential election in 2024 is a big problem. And not even Keynes and his disciples would have advocated pro-cyclical spending, where the government spends more when the economy is red hot, because, of course, that means that the government might have less money for when the economy cools down. So, certainly at the moment, we're thinking about the long and variable lags of monetary policy eventually hitting the US and the global economy with these high interest rates. And when that happens, the fiscal impulse or the fiscal stimulus will largely already be behind us. So governments will have already fired their bullets, and that makes a likely slump deeper and more painful. And also it means, of course, that central banks must currently risk the fool in the shower critical analogy, that they're not waiting for the economy to slow down, or in the analogy of the fool in the shower, that the water heats up, and they keep on increasing the temperature until they get scolded or the economy goes into recession. So, there are a few examples in human history of government spending being more productive than the invisible hand of individuals in the market. This threatens not only to be really unhelpful at a time where central banks are trying to slow the market, but also at risk crowding out public sector innovation and productivity. So for us, the most obvious misallocation of capital today can be witnessed in the ongoing energy transition away from fossil fuels. So over the last decade, there's been $4 trillion, and put that into perspective of a global economy worth 100 trillion, $4 trillion spent on wind and solar projects, which have reduced our dependence on fossil fuels from 84% of all of our energy use to just 83%. And in previous energy transitions, whether that be from wood to coal or from coal to oil and gas, an inferior source of energy has been replaced by a source of energy that not only has better energy density, but because it's superior, it has offered a whole new range of applications for industries and consumers, and capital markets have recognized that economic growth potential and been prepared to fund them. And that's resulted in a flourishing of human civilization. I think we have the opposite today, where we're going back to wind and solar, which has got much lower energy densities than the fuels that have replaced them, and also have a big intermittency problem, which becomes bigger as the market share of weather-dependent energy increases. So there's a monumental folly, in my mind, for governments to be embarking on this energy transition, which is solely dependent on coercion and subsidy, and would not occur if just the market was allowed to work without government intervention, because nobody in the market would see that wind and solar energy was better than the energy that it's trying to replace. So what we've noticed, obviously, is the wind industry is in crisis, having made the ridiculous claim that wind was cost competitive with natural gas, ignoring the fact it's a different product in that it's completely weather dependent, and with wind operators also insulating themselves from the cost of intermittency by getting the government to guarantee a price for the wind that they produce. Wind farm operators can no longer deliver those projects anywhere near the costs they previously communicated to governments, which has also been used by wind energy propagandists as claiming that wind was cost competitive with natural gas and other fossil fuels. And if you like, now having told politicians or claimed that wind was cost competitive in a bogus way, actually, ignoring the fact it's a different product and ignoring some of the reasons why wind prices have been falling, such as zero interest rates. These wind project builders have got buyer's remorse and are now having to go back to the government for even more subsidies at a time where politicians are finally realizing that net zero has never had any cost benefit analysis and is increasingly unpopular with the electorate, who have never been asked their democratic permission. Now, we understand that some institutions regard our supposedly anti-ESG views as rocking the consensual industry boat. Sadly, I think this reflects a lack of critical thinking in the fund management industry, and it's captured by a groupthink culture that regards the implementation of unthinking ESG as a political compliance regime. It seems clear to us that the inability of the fund management industry to debate the energy transition leads to a misunderstanding of its economic consequences, and that means it's more likely that it exacerbates the misallocation of capital, leading to a higher probability of a ruinous financial outcome for everyone. Now, our fiduciary responsibility is to our unit holders to allocate capital according to our understanding of the world's best and worst investment ideas. So if we can find short ideas based upon stupid business models, then that benefits our unit holders. We want to be long of wisdom and short stupidity. And in the land of the blind, the one-eyed man is king. So I think to reiterate, interest rates are at dangerously high altitude. Government spending can't be sustainably funded by private capital markets. And I think current rates of interest, higher interest rates, should kill risk assets and economic growth. So we're being paid to be patiently cautious at the moment. And I think we saw for the first 3 weeks of August that bond markets were down, equity markets were down, but the Argonaut Absolute Return Fund was up. And therefore, we keep delivering at different points to other equity funds. And more recently, as equities and bonds have become more correlated, also to bond funds. And I think this obviously isn't a fluke. We've done it pretty consistently, and that gives the fund a really unique diversification benefit for investors that want to gain proper diversification in their portfolios. And we've done this pretty consistently over a number of years. So I would recommend anyone considering investing in our fund watch our recent documentary video, The Investment Free Lunch, on the benefits of diversification through investing in a uniquely uncorrelated positive return asset.